Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today on the Econ Show, we're going to try to catch up on some of the things that we missed. It was a little bit of a slow week because the U.S. had their holiday. Obviously, a happy 4th of July. Hopefully everyone enjoyed their long weekend. And now we get to kind of catch up on some of the things that are happening within rates, within, kind of looking abroad as well as internally, because there's a lot of shifts that are happening. So how are we going to break this down? The first part, we're going to look at global food. We want to look at the food side of the equation again as droughts remain persistent. And we continue to see some issues, not only just within the U.S., but abroad. And then also rates, because rates have obviously moved a decent amount, especially when we look at within the U.S. You're starting to see rate hikes abroad. How is that going to shift things? And then we're going to look at wages, because wages within the U.S. continue to rise higher. And how is that hitting jobs? Because again, the jobs data continues to be fairly mixed. Some of it pointing to really good, some of it weakening. Some of that we covered on Friday, but we added some new data to it. So we'll try to mix it in and go through that a little bit faster. And then we're going to look at bank lending and housing, because when we look at bank lending, how are they lending? Why are they lending the way they are? And then when we look at ISMs, we want to go to the internals, supply, delivery times, prices paid, prices received. Then we're going to look at Europe, and Europe continues to improve. Italy, France. While Germany is still improving, but slowing and just not at the same level that they were. And then Asia problems continue to mount as we continue to see India, China slow down on a pretty broad scale. So now that we've gone through that, let's kick off actually with India and China. Because when we look at China, and this is coming from an account that you can see on the bottom left from Twitter, who's fantastic. When we look at what we're seeing here, so this is looking at China's air defense. So you might say, why don't they have as much in Nepal? Well, it's because that is the peak of the Himalayas, and good luck trying to get a lot of that capacity over it. And then Nepal is also part and within the Chinese sphere of influence, so they also have some of that capacity already. So when we look at surface-to-air missiles, because this is just showing surface-to-air missiles, old, new, and temporary. So you can see where the different capacity is, how it's been built, how it's focused around a lot of these areas where when you look at the recent conflict in 2020 between between India and China in the top left. Then when you look by Bhutan, when we start looking at Sikkim, like when you look at that Doklam Plateau, which is right here, you can see that's where the conflict was in 2017 that we've talked about. And you can just see what has been installed there. So new early warning. So you can see the new early warning and radar surveillance has all been put along the left-hand side, close to where the initial India-China conflict was in 2020. But we're also seeing this new build out that is starting to spread out, near Sikkim and to the left of Bhutan, and also in Myanmar. So these are things to look at when you're considering how is China positioning itself. And you can see they're starting to overload it in areas that could have the biggest conflict or friction point, because that's the easiest way to really get down and through some, obviously the Himalayas, it's very difficult to get some heavy machinery over these regions. So that's why when we look at some of the movements that we've seen, as we talked about on Friday, China has moved a significant amount of capacity into Xinjiang from Tibet. And what has India done? Well, India has not been sitting idle. So this is just layering. And we talked about this on Friday, but we want to add it in with the China side, because we talked about the Chinese side. Now we want to look at, okay, well, what is India responding to? And this is how you can see where some of these new troops are going in. So when you look at the surveillance that's being built by China, it is matching up almost perfectly where those extra troops are showing up to protect against a potential invasion, and to try to just match essentially person for person, equipment for equipment, to show strength and solidarity along these lines. So when you look, I should say solidarity on either side, as both sides continue to mount the personnel and equipment on either side of the conflict line. So then when you look all in right now, India has about 200,000 troops focused on the border, which is an increase of 40% from last year. And I can assure you those 40% are showing up at the same places that China has increased their surveillance, which obviously if, who struck first, when you look at the 50,000 additional troops that India redirected over the last few months, it has been directed at the areas that China has been building out additional surveillance, additional capacity, trying to meet the as things ratchet up and the tension grows, they're trying to meet that head on by showing force on their own side. So now that we just provided that quick update, we just wanted to look at some of the things that are happening in general within the U.S. because we've seen rates come down. After the FOMC, essentially the market is sitting here and daring the Fed not to raise, saying that you can't raise. When you look at some of the pressure in general, because the drop in the long-term yields since June 16th is essentially trying to just dictate that there really can't be much growth. So you're going to have to continue to ease. And why would that be the case? Because when you look at where spreads, or I should say where rates go, rates factor in multiple things. Rates factor in growth. They factor in inflation. So typically when you have the GDP growing, you have rates starting to tick back up where you'll see it move with capacity. So now that we're expected to grow at 9.5%, with or without inflation, because this should also carry some of that inflation risk, you should typically see that, the steepening where the long end or the back end of the curve steepens because it's factoring in a bit more inflation, but a bit more growth. And we're just not seeing that. Instead, we're seeing a bit more of a flattening. And there's comments where, well, if you think about stagflation is kind of muted in the sense where, you get some of these adjustments because we're going to get stagflation, not really inflation. And again, it's the rate of change of the money supply, which is adjusting some of these rates. So when we look at the inflation break even versus the forward real rate, you can see the inflation break even really hasn't changed all that much, while the real rate has come down. So, and something that Robin Brooks said, where you can't, his view is that you can't tighten, the FOMC markets are saying you can't tighten, you will kill growth. Now, I don't know if it's as aggressive as you will kill growth. I just think that there is a growing disconnect with what the market believes and what the Fed is indicating. And it's just when you look at some of the slowdowns that we've seen on the international side, there is, I think, some muted growth expectations, but at some point there's going to have to be a certain amount of easing when we start talking about the reverse repo purchases, which we'll talk about, because I think this is really connected in terms of why the Fed is going to have to start to pull back on the amount of purchases, which as they start to pull back on purchases and the Treasury increases issuance, that's going to start to shift things a bit. And I don't think the market is really baking in or appreciating the amount of new paper that has to come to market from the Treasury as we approach the debt ceiling, which should be hit by October. So he rounds it out by saying what's happening in the bond markets is a direct challenge to the Fed and its desire to rightly scale back stimulus and prevent overheating. So he's saying that the market, the pricing is indicating they're essentially challenging the Fed, saying you won't do it, you can't do it, and if you do, you're going to kill growth. Now, if you look at people will quote the velocity of money. The velocity of money is just a formula. It's a calculation. So you're looking at the numerator, which is the price change within GDP, divided by the money supply. So if you look at the money supply, which has grown exponentially, and growth, which has been stagnant because it's price change through GDP, and GDP has really done nothing for a decade, while they've gunned the denominator. So you're dividing essentially a stagnant numerator against a growing denominator. So you can artificially show a slowdown in the velocity of money. But if you get growth, and if we do have a robust recovery, velocity should accelerate, which would then increase inflationary pressures. And that is not what we are seeing here. And that's why there's this conflict of, who is right and where will rates go? Because again, a 40-year bond bull market doesn't die in a straight line. And when you look at the fact that we've exported inflation for the last 50 years, over the last 10 years, exporting even more through at-time deliveries and asset-light inventories, things like that take time to shake out. And I think that there's going to be that upward pressure on rates over the coming months. So then when we look at the break even, here's where the break evens have started to come back off their highs, but they still remain elevated when you're looking at the break even side. So, the dollar has found some support that has continued to climb overall. But again, our view, and we've said it on here before, was 92.60 is a comfortable spot for the dollar. Could you get a move to 94? Sure. But, realistically, it's 92.60 that makes a lot of sense when you look at, where the demand is, where the, because we continue to see countries that are trying to stabilize. They're in rate rising cycles, which we'll talk about in a minute. But they're going to need some demand. They're going to need dollars to help solidify some of their shortfalls and where they need to see some of that protection. So that, based on what we're seeing here, we expect it to kind of flatline, continue to base, go sideways, have a bit of a time correction, and then continue its trend higher. So then when we look here in terms of generic, this is just looking at the 10-year. And the reason why we're going to talk about the 10-year more is because a lot of international markets price off of the 10-year. And you're starting to see a growing disconnect where their bonds are getting more expensive and you're actually seeing some of the decline in the 10-year. And the question is, who's right, who's wrong? This is where we think when we look at the generic, as we start to see this move higher, we expect this to reverse back up. Obviously it's still off of the lows that we had in Feb of about 1%. We're still moving back up, but the thing is, nothing goes up or down in a straight line. As we've been saying, you can see the break-even inflation rate has gone at essentially a 45-degree angle. That's starting to slow down. And this is where instead of the generic 10-year rolling over, we think it comes down, baselines, and then starts to continue that trend back up. And that will pull the inflation-protected securities back, I think, to above that 0%. Now let's look at reverse repo. So what is the reverse repo? This is a bank collects liability. So what do they have as a liability? Well, if you have a bank account, savings account, a checking account, a money market account, I'm assuming you want that money back. So for them, it's a liability because you are going to want your money, so they'll have to pay you your money when you want it. So they take in your dollars, which let's say you give them $100, and they will look to reinvest 80, 90 of those dollars in loans, mortgages, and try to earn something on the back end of that. Now, if they don't see opportunity, they then are sitting on something that is earning nothing. And that's when they'll start to, they'll lend in the money market accounts, in the reverse repo markets. But when there's so much liquidity, this is just showing that the Fed is taking it in. So in order to protect rates, instead of offering 0%, they offered 0.05% or 5 basis points, and that increased the number. We almost hit $1 trillion at quarter end. Instead, we got to $991 billion, and now we're sitting at anywhere between $775 and $800 billion is kind of where we've been sitting overall, because banks are sitting on so much cash, they have nowhere to put it. And this is just telling you that the banks are fully liquid. There is so much liquidity, they don't know what to do with it. They're just giving it back to the Fed temporarily. This money has to come back out. This is not a permanent where the Fed collects it and drops it into a shredder. This is the Fed collects it, pays them something nominal, and then gives it back to them. So when you have this level and you still have the Fed purchasing $120 billion a month, this is just increasing the liquidity overhang that just remains in the system. And eventually they're going to have to cut some of those purchases, because this is just showing you how saturated the market is with liquidity. And remember, back in March of 2020, there was a huge concern on liquidity. They didn't know what to do, so they pumped in all this liquidity here. It's time to pull it out and to just stop and slowly grow, or on a gradual level, start slowing down those purchases. And now we just want to turn to the grains market for a minute, because not only do the emerging markets have a problem with, rate rising cycles as they try to get in front of inflation, but this is really where we're seeing a lot of this driven. And when you look at some of the cycles that we've seen in 2010, 2011, and if you look at the Middle East and you look at the Arab Spring, and the Arab Spring being in 2010, 2011, you have to ask yourself, given the fact that prices are going in a similar direction when we look at grain specifically, is the UAE, Saudi Arabia something similar? Are we starting to see the beginnings of a friction that's going to grow into something more? It's still early. We talk about it in depth in segment 3 of the EIA show. But this is going to be something to watch as the U.S. grain stocks as of June 1st continue to go to the lows, really driven by shortfalls in corn and soybeans, as wheat is fairly stable. But again, the corn and soybeans are so important when you're thinking about the international market and where that's going to be over time. Now, how thirsty is our food, I think, is a great point, because individuals like to think that I'm drinking oat milk, or I'm doing or I'm almond milk, or I'm doing something. I eat nuts for protein, not chicken. Well, I think this is an important view in terms of the water consumption to produce 1 kilogram of the following foods. And obviously, everyone knows that cows eat a lot, and it takes a decent amount to essentially maintain their size and obviously their sale to market. But nuts are very high up, and when you compare it to pig, chicken, eggs, you start to get an idea of just how much nuts actually consume. And the reason why that's so important is because the Pacific Northwest actually produces, and I should say the West Coast, produces a lot of our nuts, which are, and they're experiencing a massive drought of, I don't want to say biblical proportions, because there's area that this has happened before and it runs in cycles, but it is at a decade high, let's put it that way, and it continues to get worse. And then when you start looking at the cereals and milk, you get an idea of, everyone likes to point to milk as being one of those problems, but when you compare milk to nuts and some of the alternatives, you start to get some of the pressure points in terms of where the water consumption is to create one versus the other. Now, when we look at the persistent droughts affecting the U.S., you can see, and that's why it's hard to say that it's biblical, because it's happened before, but you can see where we were in 2018 and where we are in 2021. And it's the exceptional droughts are increasing, extreme droughts are increasing. Just in general, almost, I would say 60% of the country is under some form of drought, which is going to impact, how much does the water cost? How much can we grow? How much can we sell if we can't grow as much, because yield is going to be down? This is going to become a much bigger issue, not so much for the U.S. because we have enough food to feed ourselves, but the international market, which doesn't have enough food to feed themselves, and they have to buy excess. If there isn't excess, prices go up, or if there's less excess, there's more competition, so prices get driven higher. And that's what we're going to continue to see. This just puts into context where a lot of these droughts remain. And you can see it spreading into the further east. When you look at the north, bleeding into the south, when you start, and one of them is Iowa, which is obviously a big corn country. And when you look at just the severe drought into extreme drought that is starting to creep from the north further and further in towards the Mississippi, This is becoming a bigger overhang when we look at not just crops, but also nuts, berries, and a lot of the citruses that come from that part of the country, which again is going to impact yield, is going to impact just the cost, not only just internationally, but also within the U.S. So then when we look at just, rounding it out on what has happened on activity, because when you look at activity, so this is population weighted average of 50 countries. So when we look at 50 countries, you can see that overall index, we're about 66% back to normal. So we're still almost 40% away from getting back to some sort of normalcy. And when you look at time not at home, that's almost back to normal. Retail getting back to normal. Office use, public transportation, again, as we've been saying with public transport, that would get better as vaccinations increased. Road traffic, this is where we again, seeing that slowdown and just kind of that overhang when we're looking at some of the road traffic backdrops. Flights, cinemas, sport attendance is the one that we think is going to remain a fairly sizable overhang when we look at the aggregate on those 50 states, 50 countries. But again, this is just showing kind of where some of that overhang remains. So then when we look at fiscal stimulus, because we want to look at fiscal stimulus in general, you can see where the U.S. is in terms of what has been done so far. And this is looking at it as a percentage of GDP. So when you look at Japan, Italy continues to put more pen to paper when you're looking at debt that's coming to market. Germany, something similar, because remember, this is a percentage of GDP, not a net, not the gross number. Because on a gross number, the U.S. is well ahead, but as a percentage of GDP, it's a bit more measured. Still at the top, but again, or I should say, still part of the top, but still at a lower level. Where South Korea is the one that, and some of the Asian nations are going to continue to see some of their stimulus, but the pressure is going to come in India, Russia, Indonesia, and their inability, and Turkey, in terms of how can they stimulate as we're starting to see these rates increase as we've seen so far. And China is one where they don't want, and we'll talk about this more in segment 5, but they don't want their credit impulse to increase too much, but they need to do something to support small and micro cap companies, and that's what they're going to start to adjust, and we should start to see a movement to try to see some stimulus along those lines. Now, when we look at the driver of inflation, when we talk about some of these key areas, especially Russia, South Africa, Brazil, Turkey, Mexico, Indonesia, you can see that just what is driving it. And when you look at Russia and Turkey, it's the exchange rate. It's people are questioning the ability of the ruble as well as the lira to really just maintain kind of what's happening right now and just what is backing that currency. Because when you look at Russia, they have taken down U.S. dollar exposure but increased renminbi exposure. So do you trust the dollar versus the Chinese currency? They've also increased gold, so you're starting to see some of that. But Turkey, something similar. Brazil is going to have, Brazil, South Africa is going to have a lot of exposure to, obviously South Africa to crude because they're an importer, but to commodities in general. As commodities fluctuate, that's going to change the way that their currency is viewed in the market as their commodity-based currencies. Same when you look at Brazil. So these are things that we have to look at when factoring in how inflation is going to be driven differently in different countries, which is why we're starting to see the number of emerging market central banks tighten, because they have to raise rates to try to get in front of this inflationary cycle to make sure that they don't see the things overheating and their currency running away from them and unable to really kind of protect it. And what are some of the key drivers? Well, here's just one looking at rates. As rates continue to go higher, again, just every day they're just setting new records on levels going up, and it keeps trying. They're trying to see who can reach the top and how quickly they can reach that top. And when you look at some of those pressures in general, it's only increasing, especially when you start factoring in the most recent one, which are wildfires. The People's Liberation Army in China, they've talked about how they're going to do some testing, naval tests, and live fire tests, which are going to shift some of those ships away. You've seen additional problems within the Chinese markets in terms of exports, imports, again, just leading to more and more pressure on price. So then when you look at what is going to happen in general, rolling all of this together, what do the economists expect the Fed to do? And they expect the Fed to keep inflation under control. Likelihood of market inflation expectations exceeding 3% in 2022, somewhat unlikely is the most common answer, is that they believe the Fed will be able to get ahead of it. But that's some of the challenges that are arising when you start looking at what the rates are telling us. But then when we look a little bit differently, how is that going to impact growth? What is growth? And this is Latin America and how things are being hit when we talk about the COVID strains. Because Lambda, as we've been saying, and we talked about it on the EIA show, it has a unique subset which is similar to Delta, but a little bit different on the mutation side. So it's still as contagious, but it impacts it a slightly different way. So it was picked up in Peru. It is now in, I believe, about 26 countries. So the question is so far the vaccines have been able to stop it and or at least minimize its impact, which is a net positive. So the question will be, do we see another spread outside of Latin America into broader countries? Because right now the Delta variant is the most prolific in most of these new cases that are coming out, as we talked about in the EIA show. So those are some things to consider when we're looking at growth, rates, inflation, because we're not past COVID yet, especially in the emerging market world. Inflation's already an issue. We're already seeing a rate increases, and that's just going to cap some of that stimulus and slow down some of that economic expansion, which again, on the back of a potential new strain is going to be is going to hurt their economies more, which we'll talk about and kind of filter in a bit more in segment 5 when we start to make some of those broader connections between Asia and the emerging markets. And we'll try to pepper that through more in segment 3 than segment 2, because segment 2 will be more focused on the U.S. Going forward.